Welcome to the Deep Dive. Today we are focusing on a company that, well, it's been an absolute sensation on the NASDAQ this year, Nebius Group N.V, ticker NBIS. It's really seen as one of the core picks for this whole global AI infrastructure build-out. I mean, the stock price has skyrocketed over 390% in 2025 alone. Just incredible.
Yeah, that kind of hyper-growth is it's intoxicating, right? But it forces us, I think, to immediately pump the brakes and ask the really fundamental question here. Is this stock move actually justified? Is Nebius Group successfully building something durable, a high-margin competitive moat anchored by specialized tech? Or is this perhaps just a really successful marketing campaign wrapped around what might be a capital-burning commodity business, one that could be about to hit some serious financial headwinds?
That is absolutely the core conflict we have to try and resolve today. Our mission really is to cut through all the market euphoria surrounding, well, basically everything related to AI right now. We need to apply a fundamental, value-oriented lens to the source material we've looked at. We need to figure out what the intrinsic value of Nebius truly looks like, underneath all that momentum.
And here's the stark dilemma, really, for any investor looking at this today. The estimates for this company's intrinsic value are wildly divergent. I mean, we're not talking about a small swing, like 10 or 20%. The conservative bear case, which we derived from a fundamentals-focused discounted cash flow model, it places the value at, get this, a mere $30.06 per share.
Wow, $30.
Yeah.
Compared to where it's trading now.
Exactly. But then you look at the optimistic bull case. This one assumes near flawless execution of their, multi-billion-dollar strategy. And that pegs the value way up at $140.51 per share.
So that's a $110 gap between the bear and the bull case. That's colossal.
It is. And that massive valuation gap is the defining characteristic of the stock right now. It illustrates perfectly that Nebius's future value is entirely dependent on management's ability to execute. They need to pull off a highly capital-intensive, high-growth strategy and do it under intensifying financial and, frankly, geopolitical pressure.
So it really is a textbook high-stakes, high-reward venture bet, and is currently trading, as you mentioned, around $115.04 per share.
That's right. And just for context, we are basing this deep dive on information available as of November 8th, 2025.
Okay, let's try and unpack this phenomenal corporate turnaround story then. Part 1, Chapters 1 to 3. Business, Management, and Financials. Chapter 1, Business Understanding. Let's begin by really defining what Nebius is and, maybe more importantly, what it claims to do differently in what's becoming a very crowded cloud market. What exactly is this concept of vertically integrated AI infrastructure?
Right. That's really the foundational differentiator they push. Nebius defines itself by building this vertically integrated AI infrastructure. And what that means, in simple terms, is they aren't just, renting out space in some generic data center somewhere. This full-stack approach combines three critical elements. First, you've got the specialized high-performance GPU clusters. That's the actual silicon hardware, the engines. Second, there's proprietary optimized software that's designed specifically to manage AI workloads efficiently. And third, you have the underlying cloud platform interface itself. They control all three layers.
Okay, so why go to all that effort? What's the value proposition for the customer integrating all those elements? Why not just rent GPUs from AWS?
The goal is all about maximizing performance for a very specific type of customer. They aim to offer the raw, kind of unhindered computational power you'd expect from a supercomputer, but packaged with the elasticity and the flexibility of a traditional hyperscaler. It's purpose-built for AI, not general-purpose computing. And that focus immediately shifts their revenue structure away from traditional cloud towards these specialized AI services.
Right. Speaking of revenue, let's break down the core streams that are driving their current growth and presumably their future growth as well. What does IaaS, infrastructure as a service, look like specifically for Nebius?
So the IaaS segment, which they brand as their AI cloud, that's really their foundational business. It's the core source of revenue right now. Think of it as GPU as a service. Customers rent access to specific high-performance NVIDIA GPUs, which are, let's face it, the true engine of modern AI. They pay an hourly rate for that raw compute power. For example, the source material mentions $3.50 per HGX H200 GPU hour. The clientele here is typically AI research labs, big tech companies, the ones needing to train massive frontier models from scratch. It's generally seen as a lower margin but higher volume compute offering.
Okay, that makes sense. Now, here's where they seem to be making a strategic and probably higher margin play. The launch of this token factory just this month, November 2025. What does that signify? What's the shift there?
The token factory, that represents their significant move into PaaS, or platform as a service. This is their inference as a service model. So instead of renting the physical hardware just for training, the customers pay per token, essentially per unit of output, to run existing pre-trained AI models using Nebius's optimized and secure environment. They also maintain this growing library. I think it's over 60 popular open source models now, ready for immediate deployment.
Okay. That sounds like a much stickier business model, potentially with better margins too.
Precisely. The significance here is, I think, enormous. It really bridges the gap between, say, early AI experimentation and true production-grade deployment, especially for large enterprises. Think about it. A big financial institution doesn't want to mess around with hardware provisioning or managing GPUs directly. They want a secure, guaranteed service level for their customer-facing chatbot or some internal AI tool. And Nebius is offering that with the 99.9% uptime service level agreement, or SLA. That kind of guarantee is critical for getting long-term customer lock-in and, yes, definitely margin expansion over time.
Okay. Now, besides the core AI cloud stuff, the sources show they also maintain a portfolio of other interesting, though maybe non-core, assets.
Yes, that's right. These are what you might call strategically important other businesses. They include equity stakes in Everyday, which is focused on autonomous vehicles. There's also Tripleton, an ed tech platform that teaches tech careers. And they hold significant stakes in key partners like Toloka, which is an AI data collection and labeling platform, and ClickHouse, a well-regarded high-performance open source database.
So these aren't just random bets.
No, I see them more like venture call options. They give Nebius upside exposure to adjacent high-growth markets without necessarily draining all the capital away from that core AI cloud business, which needs billions in investment right now. It's a way to potentially capture future value.
Right. Let's try and define their place in the market then. They're clearly not a generalist giant like AWS or Google Cloud, but they're not exactly a tiny niche startup either. Where do they sit?
They are definitely recognized now as one of these emerging AI neo-cloud giants. That term distinguishes them as specialized AI native providers. Their whole focus is on optimizing GPU workloads. That's quite different from the general-purpose hyperscalers like AWS, Google, or Azure, who have to serve all kinds of computing needs.
But how do they stack up against other neo-cloud players?
Well, we do have to acknowledge the scale gap there. Nebius is currently smaller than CoreWeave, who is generally seen as the market leader in this specific neocloud space. CoreWeave seems to have significantly more H100 equivalent GPUs deployed right now. So Nebius is playing catch-up in terms of raw capacity, but they are doing it with, frankly, extraordinary momentum, especially given their recent history.
Okay, so that brings us to the crucial question. Why would a major customer choose Nebius over the massive scale and, the perceived safety of an AWS or an Azure? What's the structural value proposition that convinces them to potentially migrate very complex workloads?
Well, based on their positioning, it really rests upon three, I'd say, mutually reinforcing pillars. First one, performance. Because they control that full stack, we talked about the hardware, the software, the cloud layer, they can deliver what they call bare metal performance. This entire system is engineered to maximize something called Model FL OAPS utilization, or MFU.
Okay, MFU. We hear that acronym thrown around a lot in the AI space. Can you simplify what MFU actually means and why maximizing it matters so much to a customer spending millions on compute?
Sure. Think of it simply as efficiency. FLOPS, floating point operations per second. That's the raw calculation speed the chip is theoretically capable of. MFU measures how much of that theoretical raw power is actually being used effectively by the AI model running on it. Because Nebius removes certain virtualization layers and optimizes the software stack specifically for AI, their customers' AI models can potentially run faster, achieving higher MFU. And higher MFU translates directly into faster training times, faster inference, and ultimately lower overall project costs for the client. Time is money, especially in AI development.
Okay, so better performance directly leads into the second pillar you mentioned, cost.
Absolutely, they're directly linked. Nebius positions themselves pretty aggressively here, claiming to be a roughly 20 to 25% cheaper than running comparable, highly optimized AI workloads on the major hyperscalers like AWS or Azure. And when you're talking about spending potentially hundreds of millions of dollars on compute for a large model training run, a 20% discount isn't just nice to have, it's strategically critical.
Right, that's a huge difference at scale. And the third pillar seems like a structural competitive advantage, one that's particularly strong in Europe and maybe harder for US-based competitors to replicate fully. That's sovereignty.
Yeah, this isn't just a feature. It's becoming a critical regulatory moat, especially in Europe. Being headquartered in Amsterdam, Nebius can offer compliance certainty, which is becoming invaluable for large European companies. You have the incoming EU AI Act, which imposes pretty strict requirements on data governance, model usage, transparency, and so on. By offering a sovereign AI option, meaning infrastructure located within the EU, subject to EU laws, potentially with additional controls, Nebius provides the secure local infrastructure that regulated European enterprises need.
Particularly those in sensitive sectors, I imagine.
Exactly. Think finance, government, perhaps sensitive healthcare applications. These organizations need to use advanced AI models, but they can't afford regulatory missteps. Nebius gives them a path to do that without the fear of violating data sovereignty rules or the AI Act.
Okay, let's look at the wider industry dynamics for a second.
Yep.
The global AI market is just exploding, right? Growing at something like a 31.5% compound annual growth rate, driven by this big shift from pure R&D, just experimenting, towards full-scale production and integration into business processes.
That shift is crucial, moving from can we build an AI model to how do we actually scale this and deploy it securely and reliably. That's exactly why Nebius's focus on production-grade infrastructure is so necessary right now. But honestly, the most insightful data point about the entire sector, I think, comes from the nature of the co-opetition we're seeing.
Ah, you must be referring to that absolute stunning multi-year agreement they signed with Microsoft Azure. The value was reported between $17.4 billion and $19.4 billion. Just staggering numbers.
Correct. The fact that a primary competitor, Microsoft Azure, arguably one of the biggest cloud providers in the world, is willing to pay Nebius that substantial amount for infrastructure capacity, well, it's the clearest signal you could possibly get about the supply side of this market. It basically confirms that the demand for AI compute, especially driven by Microsoft's own aggressive AI partnerships, like with OpenAI significantly, massively dwarfs the current global supply. Even Azure's own substantial infrastructure isn't enough right now.
So that single deal effectively de-risks Nebius's demand side.
Massively. It provides a huge bankable revenue backlog that underpins their whole investment case. It tells lenders and investors that the demand is real and contracted.
Okay. Now let's talk about barriers to entry. This is obviously a very, very capital-intensive game. It requires billions in CapEx just to get started, let alone scale. What unique assets does Nebius possess that helps secure its competitive position and maybe give it the strength to endure the inevitable competition that's coming?
The barriers are indeed colossal. You've hit on the main ones. First, the sheer requirement for billions in capital deployment. Second, the concentration of market demand among a few large players. And third, critically, securing access to the most vital and currently supply-constrained component, those high-end NVIDIA GPUs. Against that backdrop, Nebius seems to possess three unique moats or competitive advantages that protect its position.
Okay, let's break those down, starting with the supply chain moat, the NVIDIA alliance.
This is huge. NVIDIA isn't merely a supplier to Nebius, they are a strategic partner and, crucially, a direct equity investor in the company. That's a rare and incredibly powerful relationship in this space. It strongly suggests Nebius has secured preferential access to the most advanced supply-constrained hardware, like the upcoming next-generation Blackwell systems, and specifically earmarked for deployment in Europe. When supply is the ultimate bottleneck, having the main supplier as an investor is an unparalleled strategic advantage.
Okay, that's a powerful one. The second moat you mentioned is the financial validation provided by that huge Microsoft contract.
Right. That contract translates directly into bankable revenue security. It's not just potential revenue, it's contracted. It signals very clearly to investors and financiers that the billions in capital expenditure Nebius is undertaking isn't purely speculative. A large portion of it is tied to fulfilling a guaranteed long-term obligation from a major blue-chip partner that helps secure financing on better terms.
And finally, you mentioned the sovereign moat again, specifically in Europe.
Yes, because the regulatory landscape in Europe is genuinely becoming a structural barrier against some of their US-based rivals. The Amsterdam HQ, the focus on compliance with things like the EU AI Act, it allows Nebius to target massive, regulated European markets. Markets that the U.S. hyperscalers might struggle to address quite as effectively due to concerns around data residency, U.S. government access laws like the Cloud Act, and just general compliance complexity. So these three strategic assets, let's call them supply, NVIDIA, validation, Microsoft, and sovereignty, EU regulation, these really form the foundation upon which the entire bull case for Nebius rests.
Chapter 2, Management Evaluation. Okay, let's shift our focus now from the what to the who. Chapter 2 focuses on management. We really have to start with the track record of the CEO, Arkady Veloz.
Right. Veloz isn't some newcomer. He's a founder with a solid 25-year track record. He's proven his ability to build complex, large-scale technology companies. Most famously, of course, he built Yandex from scratch into what was widely known as the $31 billion Google of Russia. So this isn't a first-time CEO learning on the job. This is a seasoned builder who understands technology infrastructure, scale, and complex markets very deeply.
However, his leadership was tested under truly extraordinary, almost unprecedented circumstances after 2022. The crisis response to the geopolitical fallout from the invasion of Ukraine and the subsequent sanctions against him personally and the company's Russian assets that required an intense, almost existential corporate pivot.
Oh, absolutely. That moment was an existential threat, no question. And Veloz, by all accounts, responded with remarkable decisiveness under immense pressure. He resigned from all his leadership roles in the Russian entity Yandex, and then he spent the next 2 years overseeing the complete and incredibly painstaking divestment of all the company's Russian assets. You have to imagine trying to separate a complex, heavily integrated, multi-billion-dollar tech entity under those intense political and financial conditions.
It sounds incredibly difficult. And what was the result of that intense 2-year pivot?
Well, he successfully executed the divestment. This effectively removed a massive geopolitical risk overlay that was crippling the international parts of the business. The remaining Dutch entity was then rebranded as Nebius Group N.V in August 2024, with a laser focus purely on high-growth international markets, particularly this AI infrastructure opportunity. And critically, Veloz himself was removed from the EU sanctions list earlier this year. This successful, albeit radical, corporate surgery performed under extreme geopolitical duress. It speaks volumes, I think, about his operational capacity and his strategic focus. It definitely gives investors some confidence that this management team can handle extreme turbulence.
Okay, let's talk about their capital allocation strategy. For a company that's clearly valued entirely on future growth potential, what's the current spending philosophy? How are they deploying capital?
The strategy is crystal clear. It's 100% aggressive growth and build-out. Right now, they're not focused on optimizing efficiency metrics or short-term profitability. They're focused squarely on building capacity and capturing market share in this land grab phase. Their CapEx deployments absolutely reflect this. They spent about $808 million in 2024. The plan for 2025 is a massive $2 billion. That money is going directly into building the data centers, buying the GPUs, and laying the groundwork needed to fulfill that huge Microsoft commitment and serve other clients in Europe and the US.
And consequently, as you'd expect with that kind of spending, we see basically zero shareholder returns, currently no dividends, no buybacks. That must be a very deliberate strategic choice.
It is. And frankly, it's the correct and necessary strategic choice for a hyper-growth company in this phase. Zero dividends, zero share buybacks. They absolutely must conserve every dollar of cash and deploy it into building the business, into CapEx. I mean, they just recently raised approximately $4.3 billion through a combination of selling new equity and issuing convertible notes. It would be financially nonsensical for them to be issuing new shares to raise capital with one hand while spending cash to buy back shares with the other. Every dollar is being channeled back into the growth machine right now.
That makes sense. I also find their venture approach to those non-core businesses of Ray Day, Triplins, particularly interesting. It seems designed to minimize risk to the core AI business.
Yes, I think that model is quite brilliant, actually, for a company in their specific position. They seem to be using the potential future success and cash flow from their profitable core infrastructure business to launch these new ventures. But then, critically, they seem to follow the model they established with ClickHouse. They develop the venture internally to a certain point, then they spin it off, secure external venture capital backing from specialists in that field, and Nebius retains a strategic, often minority equity stake.
So it isolates the risk.
Exactly. It intelligently isolates the financial risk and the high cash burn associated with projects like, say, autonomous vehicles, keeping it separate from the core AI cloud budget, which needs all the capital it can get. But Nebius still retains significant potential upside if those ventures eventually succeed. It's smart risk management.
Okay, finally in this chapter, let's address return on invested capital, ROIC. We know it's the ultimate measure of how effectively management deploys capital over the long term. Yet, you've noted that Nebius's current negative ROIC is essentially, well, meaningless right now.
That's right. For now it is. Currently, their ROIC is deeply negative, as you'd expect given the huge investments and the stage they're at. But applying traditional, backward-looking ROIC analysis to a company that's in such a heavy investment phase is really quite misleading. They aren't in the return phase yet. Think about it. They deployed over $1 billion in CapEx just last year, and another $2 billion planned for this year. Much of that expensive hardware, those GPU clusters, are still being installed, configured, tested, and brought online. They haven't even started generating significant revenue yet, let alone profits or free cash flow.
But doesn't that massive capital outlay, especially with a $115 share price reflecting future expectations, require investors to demand some assurance about future returns? Shouldn't we be applying some kind of minimum hurdle rate to the future ROIC projections to justify this massive capital commitment today?
Yes, that is absolutely the right way to think about it. The entire bull case hinges completely on the future profitability, the future ROIC, generated by all this capital being deployed today. For Nebius to ever justify its current valuation, let alone reach that $140 bull case target, that future ROIC must be exceptionally high. It needs to far exceed its weighted average cost of capital, WACC, once those newly built data centers start humming and fulfilling that huge $17.4 billion Microsoft contract and other business. And crucially, if the cost of building those centers, the I in RIC, the invested capital rises significantly due to things like tariffs or higher interest rates, which we'll definitely get into in the risk section, then the required future margin capture, the ROIC, needs to be even higher just to maintain the same projected ROIC. It raises the bar for execution.
Chapter 3, Financial Health. Okay, let's dive into the core numbers now in Chapter 3, Financial Health. And we have to begin with those really striking valuation ratios you mentioned earlier. A trailing 12-month price-to-earnings ratio of 119.07 and a price-to-sales ratio of 106.48.
Yeah, those are truly eye-watering figures. They unequivocally confirm that NBIS is what Wall Street calls a story stock. Nobody, absolutely nobody, is paying 119 times trailing earnings for Nebius's 2025 results. That's not the bet. Investors buying at these levels are buying the story, the massive growth potential projected way out into, say, 2027, 2028, and beyond. This stock is trading almost entirely on the size of the total addressable market for AI infrastructure and the core expectation that Nebius will capture a significant and hopefully high-margin share of it down the line.
We also absolutely must acknowledge the critical data limitation here. Any financial data from before 2024 is basically irrelevant now because of the complete divestment of the Russian Yandex assets. We really have to focus only on the post-pivot acceleration story, the new Nebius Group.
And judging by the recent numbers, that story so far has been incredibly successful. You just need to look at the most recent quarter reported, Q2 2025. Revenue hit $105.1 million. Now, that single quarter represented a massive 625% year-over-year increase compared to the Q2 2024 baseline of the new entity. And maybe even more impressively, it was 106% sequential growth, quarter over quarter from Q1 2025. That kind of acceleration is exactly what validates the management pivot in investors' eyes. It fuels the core optimism that they have successfully transitioned into a pure-play, high-demand AI infrastructure vendor hitting its stride.
Okay, now let's try and tackle the profitability paradox. On one hand, the company reports a deep and frankly expected net loss. The sources mentioned around $396.9 million for the full fiscal year 2024. But simultaneously, you're suggesting the underlying operational core looks incredibly robust. How does that work?
This is perhaps the most important financial insight supporting the bull case right now. You're right, the total group net loss looks alarming. But it's heavily inflated, primarily by two significant items. First, massive non-cash depreciation charges. These relate directly to the newly installed multi-billion-dollar GPU hardware they've been buying. That equipment gets depreciated over time on the income statement, creating a loss, but it doesn't impact cash directly in the same way. Second, you have the high R&D and operational spending required to fund those non-core other bets, like Avri and autonomous vehicles. These are loss-making ventures by design at this stage. The core AI infrastructure business itself, however, looks fundamentally healthy when you strip those factors out.
And what's the concrete evidence of that underlying health in the core business?
Well, two key things from Q2 2025 stand out. First, the gross margin was very strong at 71.4%. That suggests they have significant pricing power for their specialized services and are delivering them efficiently. But perhaps more importantly, the sources indicate that the core AI infrastructure business achieved positive adjusted EBITDA ahead of internal schedules. Adjusted EBITDA is a non-GAAP metric, but it's useful here because it strips out things like interest, taxes, depreciation, amortization, and often stock-based compensation and those other bet costs. Reaching positive adjusted EBITDA shows that the primary GPU as a service and the newer inference as a service models are fundamentally profitable on an operating cash flow basis once you account for the fact that the initial capital outlay for the hardware is a sunk cost for that period.
Okay, that's a crucial distinction. But then we turn to cash flow, specifically free cash flow, FCF. And those figures paint a very different picture, reflecting that high-stakes build-out strategy we discussed.
Yes, the FCF picture is one of deliberate, substantial cash burn right now. For the full year 2024, the FCF outflow was over $1.127 billion. They are spending cash at an accelerating rate. I think the CapEx in Q2 2025 alone was reported at $510.6 million. They are doing this because they must build capacity urgently to fulfill their contractual obligations, especially that massive Microsoft deal. The FCF burn isn't an accident, it's a requirement of the aggressive growth strategy they've chosen.
Right. Yet, despite that significant cash burn rate, their balance sheet, as you look at it today, looks like a veritable fortress. How are they managing that apparent contradiction?
They managed it through very successful financing rounds over the past year or so. As a result, they maintain a very conservative debt-to-equity ratio, currently just 0.261, which is quite low for a company investing this heavily. Crucially, they possess a very large cash war chest. The latest figures show $2.45 billion in cash and cash equivalents sitting on the balance sheet, largely thanks to those recent equity and convertible note raises. This results in an exceptionally high current ratio, current assets divided by current liabilities, of 14.70. What that means practically is they have effectively eliminated any significant short-term liquidity risk. They have the financial runway, the cash buffer, to execute their multi-billion-dollar CapEx plan for the next year or more without facing imminent pressure to raise more capital, potentially at unfavorable rates.
Which brings us right back full circle to the intrinsic valuation dilemma, particularly when using a discounted cash flow or DCF model. Since the DCF fundamentally relies on summing up future free cash flows, how reliable can that model possibly be for a company that's currently burning over $1 billion in FCF per year?
That's the inherent challenge. For a company with negative FCF today, the DCF becomes less of a precise valuation tool and much more of an educated guess. Its output becomes hypersensitive to the assumptions you feed into it. Specifically, it's incredibly sensitive to assumptions made about future growth rates, future margin expansion, the terminal growth rate, how much you assume they grow perpetually after, say, year 10, and critically, the discount rate you use, the weighted average cost of capital, or WACC, which itself is heavily tied to prevailing interest rates and perceived company risk.
And it's that extreme sensitivity to these forward-looking assumptions that creates that massive, almost unbelievable $110 valuation span between the bear and bull cases.
Exactly right. The bear case DCF, the one yielding $30.06 per share, likely assumes much lower long-term growth, maybe slower margin capture due to competition, and almost certainly uses a higher WACC reflecting higher risk or interest rate assumptions. Under those conditions, the stock looks drastically overvalued today. Conversely, the bull case DCF, the one hitting $140.51 per share, must assume Nebius successfully captures very high margins, maintains rapid growth for many years, perhaps growing FCF aggressively to something like $3.77 billion annually by 2035, and uses a lower discount rate. Under those optimistic assumptions, the stock looks currently undervalued. The core challenge for any investor looking at Nebius is deciding which set of future assumptions feels more plausible, more achievable, given the opportunities and the very real risks.
That massive span truly underscores the venture capital nature of investing in this stock right now, doesn't it?
It absolutely does. At this price, it feels much less like traditional value investing and much more like an all-or-nothing bet on management's ability to turn today's massive capital deployment into truly superior future profitability, navigating some significant hurdles along the way.
Okay, before we jump into the second half, covering market sentiment, ownership, risks, and our final conclusion, let's just take a brief moment. If you are finding this deep dive into Nebius Group and just generally the intricacies of AI infrastructure and financial analysis valuable, please do make sure you like this video and subscribe to Stock Analytics AI. It really helps us out.
And if you want to really elevate your market analysis and get insights like this across a much wider range of companies, you might want to consider our membership program. For just $4.99 a month, you unlock access to our entire library that's over 500 comprehensive deep dive videos covering all the S&P 500 stocks. Plus, we're adding the NASDAQ 100 next, and members also get access to exclusive, members-only requested deep dives on specific companies they want us to cover.
It really is the essential toolkit for staying thoroughly informed and hopefully ahead of the curve in this incredibly fast-moving market. Check it out, Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4, Market Sentiment. All right, kicking off Part 2, let's gauge the market's current perception of Nebius. Looking at Wall Street analysts, the consensus seems strongly bullish, which certainly helps reinforce the current high price level, doesn't it?
That's absolutely correct. The Wall Street analyst community maintains a consensus strong buy rating on NBIS, and their published price targets reflect that optimism. The range we saw was from a low of $120, still above the current price, up to a high of $149.50. This confirms that the institutional perspective, or at least the published perspective, largely buys into the underlying growth story and sees potential for significant further upside, even from today's elevated $115 level.
And it seems the media narrative and the technical picture are just as enthusiastic. Right? The overall tone seems highly optimistic, really fueled by the sheer scale of that Microsoft validation and also the recent launch of the Token Factory platform, which is seen as challenging competitors more directly on higher value services.
Absolutely. And technically, just looking at the chart, the stock is in a powerful, sustained uptrend. It's trading exceptionally well. The sources noted it was over 104% above its 200-day moving average. Now, that level of dramatic outperformance confirms the powerful, sustained momentum that's been behind the stock throughout 2025. It's clear that momentum traders, trend followers, they are fully on board with the narrative right now.
Okay, but we absolutely must address the significant countersignal here. The data point that tells us this growth story is far from universally accepted, and that's the short interest.
Yes, this is a loud and, I think, very important warning signal that investors need to be aware of. The data shows 10.81% in the total float that translates to a significant 22.54 million shares is currently sold short.
10% is quite high.
It is quite high. It means a substantial and likely sophisticated group of investors, often hedge funds or other institutional players, are actively betting against the current growth story. They are anticipating a significant price correction downwards. They clearly believe the valuation has run far ahead of the underlying fundamentals, or that the execution risks are being underestimated by the bulls.
So this unusually high short interest effectively transforms NBIS into a highly volatile battleground stock, doesn't it?
Precisely. That's the perfect term for it. It implies that any new piece of information, whether it's positive or negative earnings news, a competitor announcement, or macroeconomic data, will likely result in exaggerated price movements. You have the entrenched bulls and bears constantly fighting over the narrative and the valuation. This inherently increases the stock's volatility and the risk profile, especially for shorter-term retail investors who might get whipsawed by the sharp swings.
Chapter 5. Ownership structure. Let's move on and examine who actually holds the reins, who owns the stock. Institutional backing seems quite substantial, with the sources mentioning over 545 institutions owning up to 43.5% of the shares.
Yes, the level of institutional ownership is significant, but I think the quality of that institutional ownership is probably the more key factor here, acting as a form of validation. Specifically, the presence of strategic partners like NVIDIA as a direct equity investor is perhaps the most powerful strategic validation you could ask for in this particular industry. It signals deep alignment and likely secures that crucial supply chain priority we talked about. Alongside NVIDIA having top-tier venture capital firms like Cell also involved as equity investors signals that sophisticated financial players have vetted the company and believe in its potential. This kind of backing can also help secure access to future financing channels, which somewhat de-risks the capital structure going forward.
Okay, that makes sense, the smart money validation. But when we shift focus to insider transparency, particularly around management trading, we encounter what seems like a pretty significant blind spot for investors, one that every potential shareholder really needs to be aware of.
Yes, this is a critical drawback, and it relates directly to the company's regulatory status because of where it's incorporated. Because Nebius is incorporated in the Netherlands, it is classified by the U.S. Securities and Exchange Commission, the SEC, as a foreign private issuer, or FPI. Now, this FPI status provides certain key exemptions from standard U.S. public filing requirements that domestic U.S. companies must adhere to.
Okay, so what specifically does that FPI status exempt them from, and why does it really matter to us as outside investors trying to assess the company?
Well, the most crucial exemption from an investor transparency standpoint is that FPI status exempts company insiders. This includes CEO Veloz, other senior executives, and board members from the requirement to file public SEC Form 4s. Form 4s, as you know, are the mandatory reports that U.S. insiders must file within 2 business days every time they buy or sell shares of their own company stock on the open market.
Ah, okay. So because they are an FPI, we have essentially zero public visibility into whether the key executives, the people who know the most about the day-to-day business and the execution risks, are actually buying more shares with their own money, or if they're selling shares.
Exactly. For investors who rely heavily on monitoring management's skin in the game, Watching insider buying or selling patterns as a gauge of internal confidence, this complete lack of required public transparency is a serious impediment. It removes a key data point often used in fundamental analysis. Furthermore, while the insider trading opacity is the main issue, FPI status can sometimes impact other areas of corporate governance too, like potentially different rules around shareholder meeting notices or executive compensation disclosure compared to U.S. standards, although the lack of Form 4s is usually the most discussed drawback.
Chapter 6. Risk assessment. All right, now for arguably the most important section for anyone considering this stock, risk assessment. Let's start Chapter 6 with a quick internal health check via a SWOT analysis, just recapping the core strengths we've identified.
Sure. The strengths are definitely formidable. You have those unparalleled strategic partners, NVIDIA as an equity holder guaranteeing supply, and that massive $17.4 billion Microsoft contract guaranteeing a huge chunk of demand. You've got the structural regulatory moat developing in Europe with the sovereign AI positioning. You have proven leadership under Veloz, who successfully navigated that existential crisis. You have that fortress balance sheet anchored by low debt and substantial cash reserves, removing near-term liquidity worries. And crucially, you have evidence that the core AI business model itself is already profitable on an adjusted EBITDA basis, suggesting high margin potential.
Okay. And the weaknesses are pretty clearly linked to their aggressive growth strategy, aren't they?
Yes, they are mostly the flip side of the growth coin. The weaknesses include that substantial free cash flow burn, currently over $1.1 billion annually and likely to continue. Deep reported net losses, also projected to continue for several years due to depreciation and investment. There's also the relatively short operating history of Nebius as this newly focused pure-play AI company post-divestment. And as we just discussed, that crucial lack of insider trading transparency due to the FPI status.
Okay, we'll skip detailing the opportunities for now and focus squarely on the external threats. Because this is where the bull case, that $140 valuation, faces its most material challenge. You referred to it earlier as the macroeconomic pincer effect.
Yes, this pincer concept captures, I think, the core external risk for Nebius right now.
Yeah.
It threatens to squeeze the company's profitability and potentially its growth trajectory from two simultaneous directions. And it fundamentally threatens the high margin assumptions that are absolutely necessary to justify anything close to that $140 DCF valuation.
Okay, let's define the first side of this pincer.
Yeah.
The rising, or at least persistently high, cost of capital.
Right. This is driven primarily by the current global interest rate environment, which remains significantly higher than it was just a few years ago when many growth plans were perhaps formulated. Nebius needs billions of dollars to finance its ongoing CapEx program. They often rely on debt instruments like those convertible notes they issued, or they'll likely need future credit facilities or bond issues. Persistently high interest rates permanently increase the cost of financing all that capital. This automatically raises the company's weighted average cost of capital, the WACC, which is the discount rate used in valuation. A higher WACC directly compresses the present value of future profits and reduces the effective return on invested capital generated by these multi-year data center projects.
So basically, the longer interest rates remain elevated, the more expensive it becomes just to build the very capacity that's required to fulfill that huge $17.4 billion Microsoft contract and other growth opportunities.
Absolutely. It puts continuous upward pressure on their future operating expenses and the required return threshold before the data center even comes online and starts generating revenue. It forces them to capture even higher margins down the road just to justify the initial investment made today.
Okay, that's one side of the pincer. Now for the second side, which seems highly acute and very specific to their near-term $2 billion CapEx plan, particularly in the U.S., the impact of the 2025 U.S. tariffs on data center components.
Yes, this is a very material threat that emerged more recently. The sources highlight new U.S.-imposed tariffs, which apparently range drastically from 35% all the way up to a potential 114% on certain items. And critically, these tariffs are specifically targeting essential data center components that are often sourced from global supply chains, things like servers, storage racks, power distribution units, specialized cooling equipment, network gear, basically all the expensive guts of a modern data center.
And since Nebius absolutely needs U.S.-based data centers specifically, the sources mention a planned facility in New Jersey, partly to satisfy the low latency requirements or data location terms of the Microsoft contract. Those tariffs directly impact your construction budget for that critical facility.
Correct. The tariffs directly inflate their planned $2 billion global CapEx budget, making the physical hardware required to build those critical U.S. data centers substantially more expensive than perhaps originally planned. And the simultaneous pressure, the rising cost of capital making financing more expensive, and the rising cost of hardware due to tariffs making the actual build more expensive, directly threatens the third pillar of their value proposition we discussed earlier: cost. If their construction costs inflate significantly, their ability to maintain that claimed 20–25% price advantage compared to AWS or Azure is seriously compromised. It weakens their entire competitive positioning if they have to pass those higher costs on.
So the pincer effect, higher financing costs plus higher build costs, essentially risks turning their massive growth capital into significantly more expensive capital, which could undermine their ability to capture the high future margins the market is currently pricing in.
Precisely. It is, I think, the single most critical external threat to achieving the kind of flawless execution that the current stock price seems to demand. It puts immense pressure on management.
Chapter 7, conclusion. Okay, let's try and synthesize everything we've discussed today as we move into Chapter 7, the conclusion. What is the most compelling distilled argument for the bull case for Nebius Group N.V? Why buy this stock?
Well, the bull case, I think, is fundamentally built on two pillars: market scarcity and powerful validation. NBIS is seen as a pure-play investment vehicle for a structurally supply-constrained AI infrastructure market, a market that's growing at a colossal 31.5% CAGR. There just aren't that many ways to get direct exposure like this. And secondly, it possesses arguably unparalleled strategic validation. You have NVIDIA, the kingmaker, as an equity investor, strongly suggesting guaranteed access to critical supply. And you have Microsoft, a hyperscaler giant, signing a massive $17.4 billion contract, effectively guaranteeing a huge baseline of demand. Add to that the unique structural regulatory moat they're building in Europe with sovereign AI, and the fact that their underlying operational core is already demonstrating profitability on an adjusted EBITDA basis, suggesting the high margin potential of their specialized service model is real. That's a potent combination for bulls.
Okay, that's the bull case. Now, what is the equally compelling bear case? The argument that those sophisticated shorts, representing over 10% of the float, are likely betting on.
The bear case is essentially a warning about, perhaps, premature valuation and significant execution risk. First, the stock is undeniably extremely expensive on traditional metrics, priced at a 119 trailing PE, which requires years and years of absolutely flawless execution to justify. Second, it faces intense and growing competitive pressure, not just from other neoclouds like CoreWeave, but also from the hyperscalers themselves, who are constantly innovating and optimizing their own AI offerings. And third, critically, the bears would argue the company is highly vulnerable to that macroeconomic pincer effect. We just detailed the combined pressure of the rising cost of capital due to interest rates and the rapidly increasing data center construction costs due to new tariffs. These external factors, bears argue, could permanently compress the very high future margins that are absolutely required to justify the current lofty stock price. They see the execution path as far more difficult than the bulls assume.
Let's just restate that enormous valuation gap one last time, because it really does define the entire investment decision here, doesn't it?
It absolutely remains the core challenge for anyone analyzing this stock. The conservative DCF, the one focused more on current fundamentals and potential headwinds, values the company way down at $30.06 per share. Meanwhile, the optimistic, growth-at-all-costs DCF, the one contingent on near-flawless execution of the strategy, values it way up at $140.51 per share. The current share price, hovering around $115.04, tells you quite clearly that the market has almost fully bought into the optimistic narrative, pricing in very little room for error.
So, pulling it all together, what does this all mean for the potential investor looking at NBIS today? What's the final takeaway?
I think the clearest takeaway is that this is not your traditional, stable, long-term compounder type of investment, at least not yet. At this stage and at this valuation, it feels much more like a high-risk, potentially high-reward venture bet. It's a bet placed squarely on management's strategic vision and, perhaps more importantly, their operational discipline. The current price, near $115, implies significant, almost unwavering faith in Arkady Veloz and his team's ability to flawlessly execute that massive $17.4 billion Microsoft contract, scale the business globally, while simultaneously navigating these intensifying global financial headwinds, persistently high interest rates, and geopolitical friction points, like those new U.S. tariffs impacting their build costs.
That leads us perfectly into our final provocative thought for you, the listener, to mull over today. Looking at the bull case, which core assumption do you think is potentially the weakest link? The one that, if it breaks, could cause the stock to materially derate, perhaps back towards that $30 bear case valuation? Is it the certainty of supply, the idea that the NVIDIA alliance guarantees them all the GPUs they need when they need them, regardless of global demand? Or